Good morning. This is Christian from Tribeca Trade Group with your weekend video review on the markets, as well as some single stocks, as well as some technicals in some of the major indices and in some stocks and in some sectors. So today's video will be a little bit shorter because I do have to run out for a family engagement, but there's a lot to go through this week. I would say this week is going to be extremely interesting. There's going to be a lot of things to watch for this week. We're going into a week which is quarter end, which will be on Friday. So I do expect a pickup in volume closer to the end of the week. There will be some portfolio rebalancing that usually happens on quarter end. This just typically happens every quarter, and that volume increase. So why I think that's important is because a lot of the major U.S. indices are on support. So we'll look at this in terms of SPY. Sorry, I'm going to jump around between a couple different applications, including Bloomberg and Thinkorswim, because I've got different indicators on different things. But that kind of just sums up the whole picture. Is SPY's on the 50-day moving average. So we've been in a nice uptrend, no doubt. But last week, there's definitely been, I would call it a deterioration of momentum, as well as market breadth. Those are the major two things, but we're still holding support. So there's not really, until we break this, then we can also say, kind of make decisions about some positions. I don't really like to get out of things preemptively and like to analyze things on a case-by-case situation. Obviously indices are one thing, but stocks are another. They've got their own support and resistance levels. But for the whole market, the S&P 500, we're resting on the 50-day moving average. I don't really know, so I'm not going to make a really major prediction whether or not we're going to bounce here or whether we're going to drop, but I've got my predefined levels, and that's all that you could really define, and have a defined trading system and know when you're going to get out or when you're going to get into positions. For me, it's going to be the 50-day moving average for some positions, especially for the S&P. And also, you can see this uptrend line that I've got drawn here. We're kind of sitting right on it. A couple observations to note is that last week, there was a lot of political drama last week. So I don't know if that was really the contributing factor why we couldn't close on the highs on Wednesday, Thursday, or Friday. You could see that we tried to go several days last week and we failed. We also see the sell signal here. So these things have to play out a little bit. At the end of the day, are we really going to blame it on the political headlines? No, because in a couple of weeks later, we're just going to look at these bars and be like, yeah, we failed to close on the highs. So it doesn't really matter what the reason is. It just matters what the price action really did here. And for the last week, we could not close on the highs. We could not turn the corner. We tried a couple days last week, and we were unable to get above these moving averages. So it is what it is. That's what it is. We're holding support, and if we break the trend line here, I'll probably reduce some positions here and just kind of sit on my hands a little bit. And there's nothing wrong with that. Again, trading, people forget that there's nothing wrong with taking a couple small losses on trades and just reassessing and then going back in once the trend kind of resumes. Again, having this, I always use the saying, but it's better to be late and correct than wrong and early. So I don't need to necessarily make any predictions here, but I'm going to hold some positions as we're holding support. If we break, we're going to go lower. So sorry to repeat myself, but it's just for me, that's what the real criteria is in the market, is making sure. That's why, otherwise, why have trend lines and why look at moving averages if you're not going to follow them with your philosophy and with your trading. So if we do break, by sure, I will be out of some positions. If we manage to hold, great. I don't really have to do much, and maybe I'll add to some positions once I see a little bit of confirmation that we're going to hold support next week. Again, it's a big week next week with quarter end, so I really think that it could go either way this week. So I'm going to talk about a few other things here. I'll just kind of touch upon S&P. I think is caught in the middle, really between the three major U.S. markets indices that I watch are Nasdaq, the SPX and the Russell small caps, so IWM or the RUT. And Qs look like they're in a much bigger or much better standing right now. We don't really have any sell signals here. We have obviously dipped last week with that big day on Tuesday, but we really haven't. There's no sell signals. We're sitting right on the top of value, so I don't really think that we've breached the value area yet. And we're above all the major moving averages, obviously. So Qs look pretty good. And again, we'll have to see if they end up, if the leader in this market kind of, if it falls next week. IWM is the trouble area. That is the weakest of the three. That broke below the 50-day moving average. So again, like I said, I'm going to go back between a couple of the charts here, but you could see in IWM that we did break the 50 and we're sitting on the 100. So S&P is sitting on the 50, IWM is sitting on the 100. And if we break here, not a great sign. And it's also, you could draw this line like I have on Thinkorswim, and you could say, ooh, that's kind of the uptrend line. So that's what I'm really concerned about, is if we break the 100. Notice we don't have a lot of support until the 200, and that's quite a bit of a drop. We're talking about 134.5 right now in IWM, going all the way down to 127. So what is that? That's about $8. Just doing the math right now, that's about a 6% move if we break. Now, it's not, we don't always, we're not always, it's, once we break the 100-day, it doesn't mean that we're going to fall right to the 200, but that's where the next area of support is, which is about a 6% move down. So we experienced a bit of that. We talk about the S&P was down, just a little bit over 1% on Tuesday, but IWM is moving much faster than that. Especially to the downside. On Tuesday, it fell 2.7%. So could be another 2 more days of that if we break that 100-day moving average. So again, that's the risk that I see in the market. Where did Bloomberg just go? Is that we have a while to get to. Same thing. We've got quite a distance in the S. While I have the S&P up, quite a bit of distance between the 50 and the 100-day moving average. So that's what we need to watch for next week. Just looking at kind of other areas in the market. Let me just go back to my newsletter. I wanted to address a little bit of politics because that seems to be, I try to stay away from politics for the most part, but there's sometimes where politics really cross over into the markets, and you can't completely ignore them and kind of stay out of it, but especially when the media is harping on, they keep calling the Trump rally, and they keep calling it that if the stimulus, if Trump's agenda isn't likely that it can be accomplished, everybody is all of a sudden saying, "Wow, we're in trouble." So, is there any weight behind this theory? Well, my view, and again, I can only tell you my view and what I think, and you could either agree or disagree. But my view is that, sure, certain sectors have gotten another kick higher with hopes of stimulus, but I don't think that it's all on this Trump rally. Keep in mind, the people who are on TV are telling you that the same people that are saying that the market's going to fall because of this stimulus may or may not happening are the same people that said that we were going to fall when Trump got elected, and the same people that said that we were going to fall once the Brexit vote happened. So keep that in mind when you listen to the people on the financial media who are making these claims, as they've been wrong before. But it doesn't mean that we don't want to address it. We do want to address it. So what I would say is, if all of the move in the U.S. market since the election has happened strictly because of Trump, then the U.S. market would have been the only market that would have been moving up, because it would have been the only benefit of the promised stimulus. So has the U.S. market been the only market that's been moving up since the election? No. In fact, we are actually lagging some of the global markets. So if you look at, just a quick look on Bloomberg, and you could see, for example, look at EMEA. So again, the S&P, the Dow, NASDAQ is up more. That's up 8% year to date, but the S&P is up 4.7%. Look at EMEA. They're up. Look at the Spanish market is up 13 and over 13% year to date. So you would have to think if you're going to make the same conclusion that the U.S. market is only has gone up on Trump stimulus, then you would probably need to make the same conclusion that the Spanish market is only up because Trump is planning on doing stimulus in Spain that is going to make them go up, right? It kind of seems silly, right? But when you look at the rest of the world, I don't think the Spanish market, I'm just going to make a crazy conclusion here and say that I don't think the Spanish market cares about the healthcare vote that happened on Friday. So again, that's just one market. That's my little comparison, and maybe that kind of puts things a little bit more in perspective. It's the same thing with emerging markets. The Hang Seng is up over 10%. I don't know. Do they really care about that Trump is planning to, repeal some of the the healthcare and financial regulation? No, I don't think that they're up 10%. I don't think that the Hang Seng is up 10% because of that alone. I think that there's other things. I think that the market is healing. The global market is healing. We just saw last on Friday, for example. Sorry, this will take me two seconds to set up. But if we look at the Eurozone, and if we look at the data that came out on Friday, which I hope I can find it here, but you could see the market estimates of France manufacturing higher than expectations. France, higher. Germany, higher. The whole Eurozone manufacturing is higher than expectations. Again, anything with the PMIs and manufacturing data is if anything is greater than 50, it's expansionary. All these numbers on Friday came in higher than expectations. So kind of going back to our analysis, what I think is going to happen, and again, I don't want to get away from watching support and resistance, but when you look at some of these other areas in the market that are moving up and moving up big time, it means to me that sure, there may be a little bit of volatility in the short term. Markets don't go up straight, and they do have mini corrections and retracements, which we saw last week. I personally think that they're going to be short-lived. Looking at the Baltic Dry Index as well, the Baltic Dry Index is not moving down. It's moving up. It hasn't broken out. We don't know if this is going to be a double top in this yet. But the fact that it's moving up tells me that, and a lot of global markets are moving up, tells me that our move down may not be a long correction or a complete break in the uptrend. So again, I'm getting away from the technicals a little bit, but basically with the added volume of quarterly, not quarterly rebalance, but the end of the quarter and heightened volume, maybe we might end up breaking support on a short-term basis, and that'll keep me out of the markets on a short-term basis a little bit. But overall, I think it will be short-lived. So I'm not going to go through all the technicals. This is for our newsletter subscribers, but I've got technicals to watch in SPY, Qs, and IWM, all kind of drawn out with just levels to watch as well. I'm not going to go into detail. Again, this is for our subscribers, but basically, I map out all of the S&P sectors and talk about whether or not they're losing momentum or gaining momentum, which is the strongest. And there's no doubt there's three sectors that broke the 50-day moving average last week. So again, that is falls into the bucket of that we've lost a bit of momentum, and some sectors are starting to break down. We saw that obviously a couple weeks ago with energy, which remains below the 200-day moving average, which I think is a great place to short. So there are opportunities in this market to short and not just go one direction. So that's the main factor for me, is the 200-day moving average. Once things break the 200-day moving average, it's definitely, you have opportunities to short. So energy names, we'll keep an eye on crude. Looking at the crude chart, there's not much to really love here. Just like with the S&P, that's kind of tried to rally a couple times last week. That's been the story for crude since we've fallen here. We can't get above the yellow line, the 5-period exponential moving chart. So we're in a downtrend. We do have some support all along here in crude, but I would wait for the price action to kind of prove to me that we're out of this this move down here, and the price action has not been able to reclaim any of this. Not even a bounce. Anytime that we've had a bounce in the morning, when we come in, it gets faded, and you could see that with looking at these candles. Sometimes we come in the morning and crude's up 1%. At the end of the day, we finish down or we finish flat. So it's not being able to hold any type of rally lately. Is it completely breaking down? No, with the support, but it's not out of the downtrend that it's in. So that is that. What did ETF fund flows show us last week? For the most part, there was more inflows. There was $4.6 billion in equity inflows. However, all of those inflows went into international areas. So emerging markets, which have seen I'm sorry, I don't have the consecutive weeks of emerging market inflows, but it's probably around like 6 or 7 at this point. So you could see that was the leader in terms of seeing where the money is being put into place. And it's not just one ETF. I have these detailed out. IEMG, VWO, EEM, and EMB, which is actually emerging market bonds, are all seeing inflows. So it's not just one. IEMG did capture 1.4 billion of that, but there's a whole group of them that are seeing inflows right now. Same thing with the international developed markets. They saw $933 million of inflows. A lot of those going into names like VEA, EFA, and IEFA. What probably is the most notable change from looking at fund flows is the amount of money that's been going into Europe. This is the biggest week of European inflows, and we're going to look at some charts to kind of just show what's going on there. But if you've listened to me before, you notice, I've talked about it back in 2016, mainly for the three quarters of 2016, there was a lot of, I would call them massive outflows in European equities. Then in the last quarter of 2016, they trailed off. There wasn't a ton of inflows, but at least all of the money coming out of Europe stopped in the last quarter of 2016. And then what we've seen in the first quarter is money is starting to return. And last week, I think, was the biggest week of inflows going into Europe. Besides Europe, a couple other areas saw inflows. What's interesting is Japan for the last couple of weeks has been showing strong outflows. So I think in terms of you go into these developed market ETFs where they're multi-country. You want to be a little bit careful because Japan looks like there's a lot of money that's been coming out the last couple of weeks. I don't know if that's a short-term thing, but something to keep an eye on. So in terms of charts that I'm looking at, and while I mentioned that the U.S. is on crucial support areas, the 50-day moving average for SPY and 100-day moving average for IWM, the European markets are breaking out. The EZU, which covers the whole Eurozone, is moving up here. And then looking at, this is basically just a daily chart of EZU, but when you kind of break it down country by country, we talked about Spain. I made my little comparison to Spain and the U.S. markets, but looking at a 3-year chart, look at the price action above the 50, 100, and 200-day moving average. I think this area really looks compelling for longs. You've got your support as probably maybe the 50-day moving average, but let the retracement continue here from forming a base for about a year in 2016 and now climbing above. It's the same thing that's going on in Italy right now. Italy just needs to move above this little hump here, and this is an area that I want to get long. As long as we're all above the moving averages. Of course, EWG Germany, which is the biggest in the EZU ETF, that is also moving the same above moving above the 50-day moving average. France also looking very similar as well. So not a lot of different pictures here. They all the price action in all these countries is above the 50, the 100, and the 200-day moving average. So that's my quick review. I did in last week's newsletter, I did a whole breakout of emerging market. So that's why I'm not breaking it out again this week, because it's all in last week's newsletter. I detailed a number of emerging markets that are breaking out to the upside as well. You could add, I looked at a couple names this week in addition to what I covered last week, and look at things like Thailand. THD is another area that's breaking out to the upside, and I believe that's a 52-week high that was reached on Friday. So again, Thailand not really caring about the healthcare vote on Friday. Did I hammer that point home enough on this call? But so you have a lot of markets globally that are kind of doing this. Thailand was one. There's another one that I saw that made a new short-term high was Chile. That's ECH. Also breaking above here as well. So 44.38. You got a little bit of resistance up here, maybe at right around $45, but also moving above all the shorter term moving averages. Just returning to the U.S. markets, what looks actually interesting to me as I kind of went through and looked at all the sectors and which ones have a little bit of momentum to them. Believe it or not, utilities are getting very close to that 52-week high. So watch that level that I've got right here in the charts. That I'm not really long. I'm not long anything in this space at all. I always like to look at the ETF first to see what it's doing, and then kind of drill down to the individual components to see if any names are really setting up nicely. One of the names that I like right here is NRG. We've seen in the past, a couple months back, a lot of call buying in NRG, which has been quiet the last month. But just looking at the charts, it looks pretty constructive to me. So it just needs to climb above this level, I would say, which I think it's already done that. But I like this, and you got your support of the 50-day moving average. You got your defined support that's right below it. So if it doesn't work, you can exit for most likely a small loss if it doesn't hold that 50-day moving average, and I like that. Oh, and then the last thing I'm going to talk about, real big rotation. Nobody's talking about this. I don't see anybody talking about it on Twitter, but there is an ETF out there. It's called the Dorsey Wright, and it's the FV is the Frank Victor is the ETF, and they did a major rotation last week. So they have in this ETF. It's more of a technical driven ETF. They look at 5 sectors, and they hold 5 different sectors ETFs in the basket. That's why it's called the Dorsey Wright 5. So they hold a couple. They hold the Nasdaq 100, which I believe this is equally weighted, the QTech. FDN, which is internet, which is my FANG proxy because the FANG stocks have the biggest weight. They've got utilities in here, they've got industrials, and they've got energy. So I believe they blew out of this whole position and they distributed all the weights. So if you look at the FXN ETF, this had a look at the volume that happened on Friday. So this is, and I did check this. This was an outflow of $511 million. So notice, we talked about in the beginning of the call how energy is a short candidate below the 200-day moving average, but they just dumped their long and they distributed into other sectors here. But that's this big move here. Again, this represents $511 million, so $500 million as they dump this position on the break of the 200-day moving average. Also, the 50 crossing below the 100. So real big rotation out of energy. Again, so these rotations you just kind of want to look at, just like with when people talk about 13F filings. It happened in the past. They're not going to be unwinding anymore. I think they're out of their position, but it just shows what kind of gives you a feel of what people are doing. And as energy breaks down and goes below the 200-day moving average, it's normally a technical signal for people to get out. So that happened on Friday. That's in the past. And I did look at the volume in these other ETFs, and there was a spike up. So it wasn't one for one that somebody went out of energy and into one of these. It looks like they distributed the money equally or close to equally between these 4 ETFs based on their representative weights in that ETF. So that's it. That's a quick. I said it was going to be a quick video, but I'm looking and it's about 24 minutes long. So thank you for watching, and have a great week. And I'll see you guys in the Tribeca Trade Group trading room. Again, you can visit us at tribecatradegroup.com and get involved in our all-day trading room and our all-day chat, which we post analysis charts and go over setups, where to enter and exit all day long. And so that is at tribecatradegroup.com. Have a great weekend. Thank you.